finance guide. Hello, and welcome to India Explained. Today, we're going to talk about a really interesting question for a lot of investors out there. What exactly comes after mutual funds? Let's dive in and get it explained. And hey, before we jump in, if you find these explainers helpful for your own money journey, do us a quick favor and hit that like and subscribe button. It really makes a big difference. All right, let's get into it.
Yaar, I really need your advice on something. I've been putting money into mutual funds for a good while now, and I've built up a decent corpus. But honestly, I feel, stuck. MFs are starting to feel a bit too basic for me, but let's be real. I don't have 50 lakh lying around for a portfolio management service. Is there actually nothing in between for someone like me?
That is such a great question. And trust me, you are definitely not alone in feeling that way. For years, I think countless investors in India have felt stuck in that exact same spot, this huge gap between regular mutual funds and high-end PMS. Okay, so let's break this down. A good way to think about it is like this. A mutual fund is kind of like a city bus. It's affordable, it's accessible to literally everyone. You can get a ticket for as low as 500 rupees. But it has to follow a very fixed route with really rigid rules set by SEBI. Now, on the complete other side of things, a PMS is like having your own private chauffeur. It's incredibly flexible, it's completely customized to you, but it's really only for the ultra-wealthy. You need a minimum of 50 lakh rupees to even get started. For the longest time, if you wanted something that was a nice middle ground, well, you were just out of luck. But, and this is the good news, that is finally changing. SEBI saw this gap and has actually introduced a solution that's designed to be that perfect middle ground. So let me introduce you to the SIF. Curious, friend? SIF? Wait, that's SIF, not SIP, right? We're not talking about a SIP here.
Finance guide? Right, you got it. Not a SIP, we're talking about SIF. It stands for Specialized Investment Fund. And it's a whole new category, fully regulated by SEBI, that was created for the specific purpose of bridging that gap we were just talking about.
And this right here is the number that changes the whole game. 10 lakh rupees. That's the minimum investment you need. It's the key that finally builds that bridge, allowing more experienced investors to get access to advanced strategies without needing that massive 50 lakh portfolio. Okay, that is pretty interesting. So it's designed to sit right there between a mutual fund and a PMS. But can you break down the actual differences for me? How does it really stack up against the other two? For sure. So the biggest differences really boil down to two things: flexibility and, this is a really important one, taxation. Now, SIFs have way more freedom than mutual funds to use all sorts of advanced strategies. But honestly, the real game changer is the tax part. See, with a PMS, you get taxed every single time the fund manager sells a stock for a profit. And that can really eat into your returns over time. But SIFs? They're taxed just like a mutual fund. You only pay tax when you decide to take your money out, and that gives you so much more control. You keep mentioning high flexibility and advanced strategies. What does that stuff actually mean in plain English? What can a SIF do that my normal mutual fund can't? What are these superpowers you're talking about? That's a great question. So the first big superpower is something called the long-short strategy. In simple terms, it's a way for the fund to try and make a profit whether the market is going up or down. Right, so going long is what we all do. You buy stocks hoping they'll go up in value. Simple. But SIFs can also go short. The easiest way to think about it is like you're betting against a stock that you think is overpriced or has some problems. So if the price of that stock falls like you predicted, the fund actually makes money. This is something that regular mutual funds are just not allowed to do, and it gives the SIF manager a really powerful tool to potentially generate returns even when some parts of the market are struggling. And their second superpower is that they can invest way beyond just the regular stock market. This gives you, the investor, access to a much, much wider range of assets. And this is where the diversification gets really interesting. A SIF can put money into promising startups before they even have an IPO or get into private equity deals. They can also invest in things like REITs, which are basically companies that own a bunch of rent-earning properties, and INVITs, which do the same thing but for big infrastructure projects like roads and power lines. It really opens up doors to growth areas that most regular mutual funds just can't touch. Okay, man, this all sounds really fantastic. More flexibility, more ways to make money. So what's the catch? This has got to be riskier than a normal mutual fund, right? You are absolutely right to ask that. That is the critical question.
All of this flexibility, the advanced strategies, being able to take more concentrated bets on certain stocks, it all points towards the potential for higher returns.
But it absolutely means higher risk. It's the classic trade-off in investing. The very same things that could lead to better returns also create more volatility. You're going to see bigger swings both up and down than what you typically see in a standard mutual fund.
So let's be really clear about the specific risks here. First, as we said, there's more volatility. Second, the liquidity is lower. This isn't like a regular mutual fund where you can just take your money out any day you want. With SIPs, exits are usually restricted to certain times, maybe once a month or even just once a quarter. And third, there's this unique risk called threshold risk. If the market takes a dip and the value of your investment falls below that 10 lakh minimum, the rules might actually force you to sell your entire investment. So the main takeaway here is SIFs are not for your short-term goals, and they're definitely not for your emergency fund.
So the big question is a SIF right for you? I want you to look at this checklist and just ask yourself honestly, do I actually have the extra capital to invest? Am I genuinely okay with taking on higher risk for the chance of higher returns? Is my time horizon long enough? And do I need this money anytime soon? If you can confidently say yes to all of these, then a SIF could be a really powerful next step for your portfolio.
That makes a lot more sense now. So it's not just about having the 10 lakh rupees. It's really about being the right kind of investor, someone who gets the risks and is actually ready to take that next step beyond the simpler mutual funds. It's a powerful tool for sure, but for a very specific purpose and a very specific person.
Exactly. You've hit the nail on the head. And that's really the question we want to leave all of you with today. Take a look at your own investment journey. Have you outgrown traditional mutual funds? And are you ready for what comes next? Finance Guide. We really hope this breakdown was helpful. For more simple explanations on complex finance topics just like this one, don't forget to subscribe to India Explained. Thanks so much for joining us.